Hello, and welcome to our webinar today. We are going to be talking about combining EB-5 and new markets. This is our third in a three-part series where we are talking about strategic financing, combining EB-5 and government incentive programs. Our first two webinars have already played, and you can find those links to those webinars in the resources tab. The first one was EB-5 and opportunity zones, and the second one was about EB-5 and rural incentive programs. And I have with me today two of my colleagues, Matthew Pugh and Warren Oakes, and I'm going to turn it over to them to introduce themselves, and then we're going to talk more about new markets and EB-5 today. Matt, would you like to start us off?
Yeah, thanks so much, Jillian. My name's Matt Pugh. I'm a senior manager, and I've been doing all things commercial real estate project finance with Baker Tilly for about the last 10 years, and specialized working with new market tax credit financing. So great to be here. Thanks, Jillian.
Thanks for joining us, Matt. Warren, would you like to introduce yourself, please?
Yeah, absolutely. Glad to be here, Jillian and Matt. My name is Warren Oakes. I'm a manager here at Baker Tilly. I've been involved in the EB-5 industry since 2013, and I'm happy to share my wealth of knowledge and seeing how we can get your projects combined with both EB-5 and NMTC.
Great. So today's agenda, we're going to be talking about new markets and EB-5. We're going to give you a brief overview of both programs. We're going to talk a little bit about the geographic overlap and how you can identify whether your project is going to fit within those two programs. And then we're going to talk a little bit about the overlap of the program, what makes a good EB-5 project and what makes a good NMTC project. And we're going to also share with you an example of a financing structure that would combine the two programs. So first of all, we're going to start with NMTC. I'm going to hand it over to Matt to give us some basics on the new market tax credit program.
Excellent. Thanks, Jillian. Happy to report that the new market tax credit program has really enjoyed a lot of success over the 25 years that it's been in existence. It began in the early 2000s under the Community Renewal Tax Relief Act, and actually under the most recent tax bill became a permanent financing resource. So it had been otherwise offered under 3 to 5 year extensions. So now has been appropriated to include $5 billion of tax credits that'll be made available year over year in perpetuity. So we're really excited about that update. The program itself is administered through the U.S. Treasury's Department of the Community Development Financial Institutions Fund, who allocates those credits to what are called community development entities, CDEs, who apply to the CDFI fund each year. Each year, there's about 200 community development entities that apply. And year over year, it's roughly about 50% that will ultimately win. And the nature of the new market tax credit program is to encourage private investment into low income and underserved communities, specifically areas of high poverty, low area median income, high unemployment, in rural areas. The tax credit itself is highly competitive, meaning that there are more projects vying for those credits than supply. And then the ultimate benefit to the project is the tax credit gets monetized by an investor who earns a 39% tax credit taken over 7 years, who contributes cash equity upfront to the project in the form of a 7-year interest-only loan, typically at a rate of 2 to 3%. And at the end of that 7-year period, when the investor receives its stream of tax credits, its equity investment is forgiven, doesn't need to be repaid. and that the community development entities that receive these credits are looking to invest in projects that provide meaningful community impacts, such as, job creation, or goods and services to low-income communities that ultimately benefit low-income end users. So that's a new market 101. Try to condense it all onto one slide. So certainly more to unpack throughout the rest as we go.
That was perfect. Thank you. Warren, I'm going to turn it over to you to tell us a little bit about EB-5 and the basics of that program.
Thanks. Okay. So the EB-5 program was created by Congress originally in 1990, but then the EB-5 Regional Center program was created by Congress in 1992. The Regional Center program has been renewed since 1992 regularly, and it's set to be renewed again here in 2027. The purpose of the program is to encourage pooling of investment capital by immigrant investors, and that investment capital is then intended to create at least 10 full-time new jobs for U.S. workers per EB-5 investor. So the real crux of the program is to create jobs for U.S. workers. The investments are encouraged by way of lowering the investment amount to go into either high unemployment areas or rural areas or infrastructure projects. And what I mean by lowering the investment amount is currently the regular or standard EB-5 investment amount is $1,050,000. But if an EB-5 investor invests in a high unemployment rural or infrastructure project, then that investment amount is lowered to $800,000. Under the EB-5 Reform and Integrity Act of 2022, otherwise known as the RIA, this new law reformed the EB-5 program, and it put in a lot more measures to protect investors. An example of this is the EB-5 fund entity is now required to have either a fund administrator or an auditor go in and oversee the flow of EB-5 funds into the project.
Great, thank you, Warren. So we're going to now move into talking a little bit about, we just went over the two programs. Now we're going to talk a little bit about where the overlap in the programs are. Matt, the NMTC program has a geographic component to it, as does the EB-5 program. Do you want to tell us a little bit about the geographic areas and where an NMTC program would fit?
Yeah, absolutely. So I'll say, really just from a twin perspective between New Market and EB-5, we see similarities really from an unemployment rate. Unemployment rate for New Markets would be 150% of the national rate. And also in rural areas with either a poverty rate greater than 20% or an area median income less than 80%. There are two other predominant distress characteristics regarding poverty rate and area median income that, don't necessarily tie directly to the EB-5 piece, but just for everyone's frame of reference, poverty rate greater than 30% or area median income less than 60%. Also provide qualifications for New Markets eligibility.
Thank you. Great. Warren, the EB-5 program also has a geographiit component. Can you tell us a little bit about that?
Yes, absolutely. So there is overlap, as Matt had explained a little bit, for the NMTC and the EB-5 Regional Center program and the geographic component to it. EB-5 also looks at the unemployment rate, and it also needs to be at least 150% or more above the national unemployment average. When we look at that unemployment rate, though, we're looking at the actual project address and the census tract that address is located in. If that particular census tract does not qualify by itself based on its unemployment rate, then we are able to and allowed to combine adjacent census tracts, meaning any census tract that actually touches the project census tract can be combined with the project census tract, and we look at the unemployment rate for the combined area, And if that combined unemployment rate is 150% or above, then the project can still qualify as a high unemployment project. The alternative to high unemployment rate would be looking at the actual area, the geographic area of the project. Is it located in a rural area? And for EB-5 purposes, we don't look at the poverty rate or the area median income like NMTC does. Instead, we look at, is the project located in an area with a population less than 20,000? And is the area not part of a metropolitan statistical area or a combined statistical area? As long as the project meets those three characteristics, then it will qualify as a rural project. And that again allows the EB-5 investors to invest at the lower level, or $800,000.
Well, thankfully, we've made this a little even less complicated at Baker Tilly and created 2 mapping tools. This first mapping tool is the NMTC mapping tool. You can put your address of your project in, and it will tell you whether it qualifies. And there are links on the screen and in your resources tab, which is next to the chat, that you can find links to these maps. This other map is on IIUSA's website and sponsored by Baker Tilly. It will tell you if your project is located in a targeted employment area or in a rural area. So next we're going to talk about what makes a good NMTC project candidate. Matt, can you share with us a little bit more from your experience of what a good NMTC project looks like?
Yeah, absolutely. So we touched a little bit about, the geographic location and how this program harmonizes with bringing investment into low-income communities, which really is base layer number one. Because the program is so competitive and there's so many projects vying for the new markets, it's really driven by, what impact does the project bring to the low-income area? What types of job creation benefits are provided? What types of community service, goods or service provisions are provided? There's also a little bit of scale in terms of how the new market can, size and scale and provide the most financial benefit to the project. So typically sweet spot size is 15 to 30 million of total project costs. Again, that's kind of sweet spot. We do see less, we do see more. The financing itself predominantly supports operating businesses, for-profit, nonprofit, providers, manufacturers, healthcare, education, food banks, done work with Boys and Girls Clubs, nonprofit wraparound service providers, etc. The other component would just be, ensuring that this project has, meaningful community support throughout kind of all phases of the planning and development process. And then, really what we call in the new markets world is a but-for test. So, why does the project need new market tax credits? What would be the impact on the project if it didn't receive the credits? Really quantifying, how this financing source fills a critical gap in the financing capital stack. And then last but not least, these community development entities who receive these credits and, ultimately select the projects to invest them within are looking for projects that are ready to go. So, all construction, diligence, contracts, etc., are, either imminent or completed. Same thing on the permitting, real estate's front. And then all other sources of capital are also committed, available, etc. One component just to be mindful of is, I always say, new markets is never the leading source of capital to a project. It's typically the last component because all the other sources of capital have to be available to close on the new market financing. and also, kind of harmonize and flow within the new market tax credit financing structure that we'll preview at a very high level in just a couple slides. So.
Okay, so then we're going to move on to what makes a good EB-5 project candidate. Warren, would you like to share with us about that?
Absolutely. So I'd really encourage everyone to, when you get a chance, to actually compare these two slides side by side to really see where the overlap is. So the green circle, again, is looking at the geographic location. We're looking at the unemployment rate for that geographic location, or we're looking at, does it qualify as a rural area? And this is really beneficial and really important because this is what makes the EB-5 project more marketable on the EB-5 marketplace. Investors are looking for the $800,000 investment level instead of the $1,050,000 investment level. And they're also looking at these particular areas because when an EB-5 investor invests in these areas, their application receives what's considered priority processing by the U.S. government, by the immigration department. So that's really key there. So that's the green area. Moving on to the red, this is a little bit different from NMTC, but there's still overlap. We're looking at new job creation specifically. It can't be jobs that are moved over from another place or jobs that are already in existence. It needs to be new full-time positions, and that means at least 35 hours or more a week. For projects, large-scale projects like we're probably talking about here, the job creation is looked at from two categories. We look at the expenditures of the project is making in order to be built, and then we're also looking at, after the project is built and operating, what are its revenues. So in those two categories, we take the development budget as well as the 5-year pro forma. And our team of economists here at Baker Tilly can put the data into an economic model, and that model will then spit out direct, indirect, and induced job creation numbers. And that's the beauty of the EB-5 Regional Center program. The Regional Center projects are able to tap into all three categories of job creation and not rely solely on W-2 employee hires. Moving on to the black circle, this is, again, another overlap with the NMTC structure or an NMTC program. The project should be ready to go. In the EB-5 world, we call this being shovel ready. Now, this doesn't mean that the project has to be ready to start construction tomorrow. What this does mean is that you should be well on your way to starting construction, let's say within the next few months or so. Looking at it in more detail, you would want to see that your development budget is complete and almost finalized or basically finalized. And that budget should have supporting bids or contracts to support the numbers that are in that development budget. We'd also want to see that land is also under control by the project. The project is able to build on that particular piece of land, and that the permits are already in process. Next, all the capital sources should be committed. This does not mean fully committed, but it means that there should be marked interest, and we should at least know where the money is more likely than not to be coming from for the project. And finally, usually a good indicator of a project being shovel ready is that a market analysis or feasibility study has already been done, and that everybody is relatively confident that this business is more likely than not to be successful.
So now that we've looked at the two programs side by side, and as Warren suggested, we would love you to take the slides on your own to compare them. We're going to sum it up. I'm going to turn it over to Matt to talk a little bit about what makes a good twin EB-5 and new market tax credit program.
Yeah, absolutely. So I think at its baseline level, ensuring that the project qualifies from a geography standpoint within our two mapping systems is step number one. Secondarily, projects, in the size range of 15 to 30 million. Again, could be a little more, could be a little less. Also are nice, nice in terms of their quantification. From an asset class perspective, success areas continue to be education, healthcare, manufacturing is kind of the predominant spaces that we see coupling nicely, and then really providing meaningful community benefit. New markets is a little more flexible in terms of its benefits, such as providing healthcare services, education, workforce development, etc. Whereas EB-5 is a little more focused on the job creation component, but within healthcare education, there still continues to be good job creation. So, quantifying those job creation aspects and how they benefit the low income areas is fantastic in terms of thinking about the coupling of both of these programs.
Thank you. And on our next slide, we're going to walk through what a structure would look like, a financing structure for an NMTC EB-5 transaction.
All right, and Jillian's got me on the clock. I can't spend too much time here. This is probably more than you need to know for today, but worth just giving a lay of the land in terms of that new markets does involve a pretty sophisticated financing structure, but at the end of the day, really provides cash upfront to the project in the form of a 7-year interest-only loan. So what we have here is a $15 million total development budget. Just by way of example, that's receiving $10 million in new market tax credit allocation and $5 million of EB-5 equity. So on a $10 million allocation, the investor earns a 39% tax credit and provides, about $3 million into this structure. That's going to be that top left quadrant of the diagram. In order for that investor to earn its credits, there needs to be other sources of capital that flow into this investment fund, that top middle box. And where those come from are really the sources of capital that would otherwise finance the project flow through this financing structure. So you'll see in that top right box, we have our other sources of capital that flow into this entity that's called our leverage lender. Usually that's like the project sponsor, who's doing this project. So the other source of capital would be the $7.5 million that comes into the investment fund by way of a loan. That investment fund will make a qualified equity investment into the sub-CDE entity, and that sub-CDE entity is also a special purpose entity that really makes 2 loans ultimately to the project. The first is a $7.5 million A loan in this example that traces 1-for-1 to that leverage loan in that top right quadrant. And then the second loan is approximately a $2.5 million B loan, which is the new market tax credit equity. The whole reason for doing this financing structure and pursuing new markets is for that new market tax credit equity to the project. And at the end of the 7 years, that B loan doesn't need to be repaid, is forgiven, is retained within the project. And typically a commonplace structure for new market projects is, creating a special purpose entity that will, own the land, construct the project, etc., who will ultimately be the recipient of the new market tax credit loan proceeds. And then I'll kind of turn it over here to Warren here just to quick touch on, kind of the standard structure protocols for how the EB-5 flows.
Thanks, Matt. So EB-5 can fit nicely into this. And as you can see, I'm in the lower right-hand corner. There's the EB-5 loan or equity box. The EB-5 funds typically will go into an SPE that silos the funds and the EB-5 investors into that one entity. And we call that entity the New Commercial Enterprise, or the NCE. That NCE then, in this example, makes a $5 million loan or an equity investment into the project itself. We call the project the Job Creating Entity, or the JCE. And we call it that because immigration and the U.S. government looks at what entity is actually expending the EB-5 funds for job creation purposes. And in the EB-5 structure, that's typically the project itself. So the money goes into the project, and then all the EB-5 investors will get job creation credit based upon that project's expenditures as well as its operational revenue. So like I said in the beginning, it fits in nicely with the NMTC structure, and all the money flows into the project and the project can get up and running.
Great, thank you both. So that is an example of what it could look like for a financing structure. And that is the end of our presentation for today. A little bit about how we can help. I wanted to turn it over to Matt. He can share a little bit on his expertise in NMTC and how he's helped clients in the past.
Yeah. Thanks, Jillian. I will say we at Baker Tilly, we're proud to have a team of about 60 professionals that work day to day on new market tax credits. We really do top to bottom in this space and are one of the leaders in the industry. We help community development entities apply, deploy the credits year over year. We manage a portfolio of $5 million of loans. So we do the loan servicing and compliance for our community development entity clients over 7 years. We'll do all the financial modeling, structuring, etc. That's required to close. And really, last but certainly not least is where I sit predominantly is helping projects secure access to these credits. So qualifying the development opportunities from the beginning. What are you thinking about? Is this a good fit for new markets? Is this not? Don't hesitate to reach out and call to just start the conversation there. We can get to the bottom of it really quick. And if there's an opportunity, then we at Baker Tilly, we work, really side by side throughout all stages of the process to structure the financing, secure it, close it, and then move it off into the beautiful 7-year new market period, etc. So just some of the roles we play in the new market space. But again, really appreciate Jillian and Warren, you all having me be on today.
Thanks so much, Matt, for joining us. Warren and I are on the EB-5 team, and we are working on structuring projects, business plan development, economic reports, TEA letters, providing clients with qualified EB-5 projects. So please reach out if you have questions about the EB-5 program. We'd be happy to speak with you more. Also, as we're concluding our webinar, please, if you have questions, we will follow up with you individually. So please feel free to drop those to us, and we look forward to seeing you again in the future. Thank you so much for joining us today. Thank you, Warren. Thank you, Matt.
Thanks, everyone.
Thank you.
Have a great day.